What's going on, my fellow wealth creators? Matty Ice here. In this video, I want to share an awesome conversation I just had with my friend Dan Korth. We actually connected on LinkedIn, and we are talking about indexed universal life insurance, the risks involved that are oftentimes not disclosed by the agents that sell them. We talk about a lot of all the things that could potentially go wrong with them, but why I really wanted to bring Dan on to the channel was because he's going to share a real life case study of a client that he's working with right now that was promised the moon with this IUL. Unfortunately, it's not going to happen. It very much under delivers. And here's the crazy part is that the IUL is actually outperforming the original illustration right now. So you would think client would be happy, right? But the amount of tax-free retirement income that was promised to her based on this very wildly unrealistic illustration, it's not going to be anything close to what she actually gets in reality. And the frustrating part, really the sad part about this is that people believe these illustrations, they believe the agents, and they make plans around the IUL and the income that they think they're going to get, right? So they're making all these plans, but then when you find out, fortunately for this particular client, she's finding out early enough to where the situation can be rectified. But a lot of times that's not the case. You find out too late, and now you're not getting anywhere near the amount of retirement income that you thought you were going to get. And so the point of these types of videos, guys, is to give you the information you need to make an educated decision about whether or not IUL is right for you. Oftentimes, like if you're like me, even Dan, he almost purchased an IUL also. Fortunately, he didn't. I didn't either. When you learn how these things actually work, you tend to go the other direction. You don't really want anything to do with it because there's just too many things that can go wrong. There's too many things that the life insurance company can change that can negatively impact the long-term performance of your policy. And you have no control over that, right? So for me, the additional potential reward that you can get over something like a whole life policy, it's not worth the additional risk. But at the end of the day, you're the one that makes that decision. But you can't make a properly informed decision without having all the facts, right? Knowing how these things could potentially go wrong. And if you're okay with the risk, fine, you can pull the trigger. That's okay. It's your decision, right? But a lot of people are buying these things without understanding how they actually work, what the risks are involved. So we need to know that stuff, right? So make sure you stick to the end because we have some really, really good points that we talk about. And also, I just put together a brand new guide about the risk of IUL. I will link that down in the description. It's completely free. Please make sure you get it because it lists out a lot of the primary risks involved with IUL that you need to be aware of. And I'll be adding more content to it over time as well, but make sure you check that out. And I hope you enjoy the conversation. Talk to you soon. And we're live. What's going on, my fellow wealth creators? Matty Ice here. We're going to have a really fun conversation today. We got some really interesting stuff to talk about regarding IUL. And today I have my new friend, Dan Korth, joining me. Dan, really appreciate you being here, man. I've been looking forward to this for a while now.
Likewise, honored to be here.
Yes, sir. So just a little context, guys. Dan and I, this is actually the first time that we've met like face-to-face on Zoom or whatever. But we've had some discussions on LinkedIn. That's where we met, and we've commented, I think, on each other like a couple of posts and stuff like that. But recently, Dan made a comment on a post that I believe it was from that Elon Moaz made, which I've had on the podcast as well, and we broke down his book and his experience with universal life and stuff like that. It's just absolutely crazy. If you guys have not read that book, you absolutely need to. But Dan left a very concerning comment, I should say, that really caught my attention. I thought was really important to bring to the forefront and to get him on the podcast to share his experience with this client who is unfortunately another victim of the just massive, incredible misrepresentation of indexed universal life insurance, where it's so overhyped and misrepresented, like just crazy deceptive marketing practices, whether intentional or not. It really doesn't matter because at the end of the day, people are still getting hurt. And I thought it would be really valuable to get Dan on the channel here to talk about his experience. So we'll get into that in a moment. But Dan, so this is the first time that you and I have had a real discussion here, and you've been on the channel. Why don't you just give a brief background about your experience in the industry, what you specialize in, and who you typically help?
Yeah, absolutely. So I actually started my professional life as a mechanical engineer, jumped into the aerospace industry right before the Great Recession. So my intro to the real world of finance was watching everybody's 401ks blow up. And so I almost immediately into my career started looking for alternatives, and pretty quickly ran across this infinite banking concept, this idea of using overfunded life insurance. Talked to an agent, almost set up a policy, and just couldn't get over the sense that there was something about it that felt like snake oil. And so I walked away, and glad I did, because it turned out that was an IUL the guy was trying to pitch me.
Yep.
Really, I was just trying to answer the question, what do rich people do with their money? And over the course of about 2 years, I kept running across this concept of using overfunded life insurance. And so finally I was like, there's got to be something to this if all these smart people are doing it. So I jumped in. I've been using it personally for about 12 years, almost 12 years now. Love it. Got a couple of policies. I use them all the time. I'm primarily a real estate investor. And about four and a half years ago, I had the opportunity to jump in with, initially just a part-time coach with a group that I was working with. And about 4.5 years ago, I had the chance to come on full-time. So I've been helping people set this up for about 4.5 years, helping them use it to build their real estate portfolios, and just absolutely love it. But in the course of that, like you, I keep running across these IULs and people getting hurt by them. And it's heartbreaking every single time.
It is. It's crazy how similar our stories are. So you got into this industry, really trying to solve your own problems with money, or trying to find, the most efficient ways to put money to work. You came across the infinite banking concept, and that's kind of what got you into the industry. Is that about right?
Yep.
Yeah. So you started implementing this really powerful strategy, and then you wanted to help other people with it. It's crazy. That's exactly how I got into the industry. But also, I was just like you. I was this close to pulling the trigger on an IUL. I took that ride through IUL fantasy land, is what I call it, and drank the IUL Kool-Aid, man, because it sounds so good, and you don't hear. There's not a ton of content. Like, I should say this. There's significantly more content on the internet about how amazing IUL is than there is content disclosing the risks and all the things that can go wrong. It's not to say that someone shouldn't do an IUL and that it can't fit in some scenarios, and we can get into that. But I think we can agree, just based off what we've seen so far in our career to this point, that 99% of people probably shouldn't have the IUL that they have because it's so misrepresented. And I thank my lucky stars every single day, man, that I did not get an IUL.
Yeah.
And I continue to do my research, which is really my goal with this channel, is just to get people to do their own research, ask questions, really make sure they understand what they're putting their money into. Because like you, Dan, I started the infinite banking concept with my whole life policies. I use them all the time for real estate. I do private money lending. It's freaking awesome. I mean, you want to talk about accelerating the wealth building process in your life? This strategy is amazing, but it has to be done correctly. Yep. And it's certainly not done with Index Universal Life. When you actually study infinite banking, I mean, I'm of the opinion that Nelson Nash is probably rolling in his grave right now because of how many IUL agents are pitching his incredibly powerful strategy and using his legacy to sell their crappy IULs. It's just, man, it's really sad. Like you said, It's really heartbreaking to see how, people just getting taken advantage of, taking huge hits in their personal finances. I mean, we're talking like, I've seen policies where people lose tens of thousands of dollars in a relatively short amount of time. I was talking with Chris Kirkpatrick, it was like a month or two ago, and he was working with a client where he's been funding the policy with, I think it's 6 figures per year, and for many years, and he's still in a massive loss because of the surrender period and stuff. It's really bad.
Gosh.
So yeah, very similar story getting into the industry, though. I wanted to share this infinite banking concept, help people with it, but also protect people from IUL, make sure they know what they're actually getting into, because I almost put a decent amount of money into those things, and I would be not a very happy camper knowing what I know now. I can tell you that.
Yep.
So let's what I want to do is I'm going to go ahead and read your comment here so that people have some background on what we're talking about, and then if however much you can share, obviously without disclosing any private information of the client. Obviously, we're going to make sure we don't do that. But this is a real life case study that you are working with right now. I'm going to go ahead and read this. All right, we've been placing this is your comment. We've been replacing a much higher number of underperforming IULs this year than normal. Just tonight, I met with someone who had a policy that she'd been told would provide her with $50,000 of annual tax-free retirement income, which is the huge promise of IUL, in addition to that upside potential downside protection. It's just this ridiculous amount of retirement income that you're going to get. All right. So we continue. She was shocked and disheartened when I had to point out that she would only be able to take that income for 6 years before the policy would lapse, or she could take $10,000 per year and theoretically maintain her principal. Another heartbreaking story of someone who was drastically oversold on what IUL can do in retirement. So let's break that down. First off, how did you come across this case? Like, did they reach out to you from social media, or how did she present this case to you?
Yeah, so she and I are both part of a real estate investing group, and that group back in probably late 2023 had started pitching the infinite banking concept as a way to enhance what we were doing in the group. And they were doing it with whole life insurance. They were doing it the right way. They partnered with somebody that sets it up great, and I was loving it. I was in there and I was excited and I was helping people. And I had pulled back from that group for a while, and I re-engaged in February when I was talking with somebody, and they said something about infinite banking 2.0. I'm like, what the heck is that?
Oh,
so
boy.
I jumped back in only to find that now they had switched and were telling everybody that whole life is a scam and you should use only index universal life. So I've been in there as much as I can, just, finding the conversations where people are talking about it, trying to help them understand, because they're just being overwhelmed with all this noise about, IUL.
Right.
Anyway, so she and I met there. She saw a post, or I saw something, she commented. Anyway, so we connected through that group.
Gotcha.
And she has actually been doing a lot of good work. I was the third agent that she'd met with to review her existing policy to try to understand, is this what everybody's talking about? Is this going to work? And so I kind of started with, well, let's back up. Like, you've already got this policy. Let's back up and look at what were you originally trying to accomplish when you set this up? Because it wasn't infinite banking, because you didn't know what that was. So what were you originally trying to accomplish? Then let's look at how well is it doing that? And then we can talk about, is this the right tool for infinite banking? Right. So I've got, see if I can figure out the share here. All right. So I didn't actually have the illustration. These are screenshots from the video, so I've redacted all the personal info, but gone through. So right out of the gate, you can see this is the non-guaranteed. So this is their most optimistic scenario. And right at the very top, it's saying your policy will lapse. They even give her a date. She can circle on her calendar when the policy is going to lapse unless she pays a higher premium, right? Now, what is screaming at me is you look at the table here and they're not assuming any income. So without even taking income out, they're telling her that her policy will lapse.
Right.
Right. Huge red flag.
Yeah.
Now, if we come down here and look at the rest of the table, I wanted to see, how far does that get her? So to be fair, that's age 101. She's probably not going to live that long, but at age 85, her policy peaks in terms of cash value, and then it starts to decline from there. And as we always see, it accelerates over time as she gets older and that ART gets more expensive.
That's crazy. Right? And that's without income. That's crazy.
That's with no income.
Yeah.
Right.
I don't know if I've seen that before.
Yeah. I hadn't either.
Where in the non-guarantee, like the most optimistic version of the illustration, I don't think I've seen that before.
Yeah. That was new to me. And to see that with no income was just crazy to me.
Can you zoom in on it just a little bit, just to make the numbers a little bigger?
Yeah.
There we go. Okay. And so how long was she funding it for?
So she had, so let me back up to her story a little bit. So when I asked her, what was your original intent setting up the policy? She said she went into, I think she said it was a guy at a bank or credit union or something, and they were talking about her finances. And she said, I just need something that I'm not going to have to worry about retirement. And so his solution to that, or her solution to that, was an IUL. So the intent was for her to fund $10,000 a year. She's now 6 years into it. So she's been doing the right thing. She's funded $10,000 6 times. She's put $60K into the policy. Okay. And what we're looking at was the original illustration. So 6 years in, she should have had, and I apologize, it's a little messy because it's a screenshot, but she should have had 48.5 roughly in available surrender value and 53K in accumulation value.
Okay.
Okay. Now, what's interesting to me is her policy was actually running ahead of where it was supposed to be. So what I told her is when I look at any policy, whether it's a whole life and IUL, the two things that I'm kind of looking at first are how soon do I get to the point where it's growing by more than I'm putting into it? Mm-hmm. So if you're putting in 10K, how many years is it going to take till it's growing by more than that? And then where do you hit your break even?
Right.
And as IULs go, this is doing pretty well. So by year 5, here where I've highlighted in yellow, she's already growing by more than the 10K she's putting in. And then by year 13, she's broken even. Year 11, she's over surrender charge. A lot of surrender charges are 15. So I told her as IULs go that I've seen, this is actually not, I mean, this is far from the worst. Like it's actually growing pretty decently, performs okay, right? I mean, I would design even a whole life policy more aggressive than this, but as IULs go, this is going okay.
Right.
Now, what was interesting to me as we dove into this, she didn't have an in-force illustration, but she'd gotten some updated values from her agent. And I have to apologize. This is kind of an eye chart because I can't stop being an engineer. But so her actual accumulation value at this point is $56,000. So she's 5.4% ahead of where she was projected to be when the policy was put in force. And her actual cash value is 51.4, even accounting for the surrender value or surrender charge. So she's actually 6% ahead of what she could actually use compared to the projections. So I said, that's rare, but that's awesome. Like, sure. I'm glad
it looks like it's outperforming. I mean, it is at this point.
It is. So what was interesting to me then is as we dove in and she drops this bomb that, you know, so the plan that the agent worked out with her was she would fund $10,000 a year through age 60. Okay. So that's 23 years. You can see down here. And then she would stop paying premiums for 5 years and start drawing income at age 65. And she said, at age 65, I'm supposed to be able to take $56,000 of income. And that's where I was like, okay. So even though it's performing ahead of what it's supposed to be, it's doing better than it was projected to do, let's break that down.
Yeah, the math ain't mathing. That ain't adding up, dude.
Exactly. And so on the call, I mean, kind of my back of the envelope math was I come down to, where did that go? Sorry, one of these I had it broken down.
I mean, while you're finding that, what's crazy is that, like, so $56,000 per year, but at age 64, she only has like $318,000 of cash value. How's that going to last? How are you going to take $56,000 for 20, 30 years when you have $318,000 of cash value? That makes zero sense.
Exactly. So yeah, live on the call, this is my back of the envelope that I'm showing her. Okay, you've only got 327 at that point. If you 56 a year, you're out of money in 5 or 6 years.
Right.
And so what I pointed out to her is your policy after the cost of insurance, because you're not paying any premium at this point. So most of your growth is going to the cost of insurance. After that, you've got $10,000 of net growth. So if you're taking more than that in annual income, you're burning down your principal, you're going to slow down your growth, and you're going to accelerate the policy falling apart.
Right. Wow.
So, I mean, you can imagine how that sounded to her. You know, she's been, I mean, I said, in order for an IUL to work, which in theory it can, it's got to be designed right. It's got to be funded, like fully funded. The market, the call option strategy's got to work out, and all of those things have to go right. The cost of insurance.
Basically, the stars have to align.
Yes.
In essence.
All these things have to work out. And I said, so far, based on the 6 years of experience, all of that is lined up. You funded it right. It was set up to where it's performing ahead of projections, but ultimately at the end of the day, it utterly fails at what it was intended to do.
Right.
Right.
So real quick on that, Dan, was she, I have to imagine that if the agent promised $50 or $56,000 per year, whatever, that had to have been illustrated to her, right?
Yeah.
Like you can't just pull that number out of your rear end. You have to show that to the client, right? So was she shown the illustration taking out the income?
I assume so. This is all she had when she had
Okay, this
asked
is
for
just
income
what she had.
source. Yeah,
Gotcha.
when
Because
when
this
she
isn't
asked
showing
for a
income, so
right, she had asked them before we met for an updated illustration, and they just resent her this, which didn't actually illustrate the income.
right.
But that's what he told her, is that you should be able to get 56 starting at age 65.
Right.
So I agree. I would assume she had to have been shown an illustration showing that at some point, but I don't know how. I don't know how that's possible. And
Yeah.
even stepping back just from a very conceptual standpoint, to think that you can put 10K a year into something for, admittedly an extended period of time, but then pull out 5 times that amount every single year and have it last for 20 or 30 years,
Right.
that just doesn't make sense.
Let's just yeah. And that's why, like, if we just use a little bit of common sense here, that, like, do we really think that's possible? Like, the numbers just don't make sense unless it's some kind of magical financial product that's getting 10, 12%, like Dave Ramsey's mutual fund. Maybe
Yes.
this is Dave Ramsey's IUL right here earning 12% every single year, but I'm pretty sure that's not the case. So if we just use a little bit of common sense, the numbers just don't add up here. And
Yep.
that should be a really, really big red flag. I mean, you should be asking yourself, I mean, is this a little bit too good to be true here? Because this looks really good on paper, and that's the biggest issue. One of the biggest issues with IUL, it looks really good on paper, but is that going to happen in reality?
Right.
And as you can see, I mean,
Yep.
just look. What's weird about this too is that this policy is actually outperforming.
Right.
So you would think it's going to deliver on its promise, and hopefully the policy will continue to perform, and maybe it can provide some income. But there's a very big difference between telling somebody they're going to get $10,000 per year in income and $50,000 per year in income.
Yeah.
That's a huge difference. And
That's
if they knew that from the beginning, would they have purchased the policy?
Right.
Probably not.
And
Maybe.
Somebody
Maybe
comes
not.
to you and says, I don't want to have to worry about retirement. How in the world is this the first thing that anyone trained in finance goes to? A life insurance policy.
I think that's the thing. Is they're not trained in finance. Maybe that's what it is.
Yeah.
Like, I don't know the agent that sold this. I mean, although, man, I do, I was going to bring this up later, but I do see people with, lots of different certifications and licenses, CFPs and all this stuff, saying some crazy stuff about IUL. So maybe not. Maybe even with a finance background, they're still recommending this. And I think one of the reasons, I mean, we both know why, is the commissions on these things are absolutely insane.
Yeah.
When we set up whole life policies for infinite banking, we lower the base premium, increase paid up additions. That significantly cuts our commissions down because that's how you do it. With these, I mean, the commissions on these things are insane.
Yeah.
So a couple of other things I wanted to ask about the policy design, and then we'll go from there. Can you go back to scroll back to the beginning? I want to make this point really clear to clarify. One of the reasons why, there's a lot of reasons we don't use IUL for infinite banking. Okay, but here's one reason. You see that cash surrender value right there? That's pretty awful. You put $10,000 in and you have access to around $700. How are you going to implement infinite banking with that? You need cash value in order to implement the infinite banking concept. And one of the problems and issues with IUL is these surrender charges, this surrender period, where you don't have access to a lot of your cash value for a long time. Now, there's ways to design it, riders you can add or whatnot that do give you access to a good amount of cash value in the beginning. There's usually a cost to that. There's no free lunch in life insurance, guys. If you're getting a benefit on the front end, something's being taken away on the back end, right? You have to ask the agent, is this because I'm getting access to early cash value in my IUL in the beginning, am I losing out on something on the back end? Is that going to diminish the long-term performance, the growth in any way because of this additional cost or fee? Right? These are questions you have to ask. But right off the bat, I see this, if it was, and it's sold for infinite banking and eventually retirement income, this is awful. You don't have access to any cash value. It doesn't work. right? And then I think there was one other thing I was going to mention about it, but I wanted to make sure we pointed that out because we talked about infinite banking. Was this policy sold for infinite banking, or was it just the retirement income?
No, to be fair, this was sold for retirement income, and so
Okay,
that
makes sense.
low cash value wasn't as big a deal in the beginning for her.
Gotcha.
But that, to your point, these things are sold all the time with that intent, and that surrender charge eats into it pretty significantly.
Right.
So you got to be aware of that.
So what are you guys doing with this policy right now? What's the game plan that you've put together?
So we're still looking at it. I put together a whole life policy that would basically 1035 out the cash value, the cash surrender value. So if she chooses to go that route, she's going to take a hit of about $4,600. But then we would take that same 10K a year, transfer it over to the new whole life policy. And on paper, which again, even in whole life, an illustration is only as good as their current dividend projections. And so, I had to point that out. But what was interesting to me is if I went out to age 65, so I use the same concept. We fund through age 60, then do a premium offset using the dividend to cover the premium, no out of pocket cash through age 65, and then she starts drawing income. So with all the caveats of dividend rates may change, and this was a direct recognition policy, and so loans are going to impact the dividends, all of that.
Right.
But I said, just notionally on paper, this policy is projecting it was about $22,000 a year of net growth. So self-sustaining could still generate more than double the income if that's how she wanted to use it.
Right.
So that's what I've proposed to her. We're going to meet on Thursday and do round 2 of this. Now that she's had some time to think about it and process it all, and decide what she's going to want to do. But I told her, regardless of what she does, she's got to understand life insurance is not a retirement strategy. Whether it's this new policy, whether she keeps the IUL, she's got to partner it with something else or pair it with something else that's actually an investment that can actually generate the kind of growth to stay ahead of inflation, to generate a meaningful amount of income. At best, either of these policies is going to be a way to buffer the volatility in that other strategy, to provide some supplemental income, some added security, things like that. But that's what life insurance does. And I mean, again, just so many of the agents that pitch it as though it can be a primary source of retirement income. And it just, life insurance just isn't that.
It was never designed to do that.
No.
And we probably talk about that and make that its own episode.
For sure.
Where selling life insurance as a primary source of retirement income came from, I have no idea. Because it can provide supplemental retirement income, absolutely. Mm-hmm. But if you're relying on it purely a life insurance policy for retirement income, you're going to be probably very disappointed, as we can clearly see, because it's not meant to do that. Does that mean it's bad? No, we just need to use it for what it is. Right. Another example that I give when talking about retirement is if we're talking about annuities, like, where this idea came from that annuities are awful. Again, that doesn't really make sense. Maybe variable annuities, but we're not usually doing variable annuities. Annuities are the best income vehicles on the planet, right? But if you have to use them correctly for what they were designed to do, which is create guaranteed lifetime income. It's not a good wealth accumulation vehicle, right? So a lot of people try and use it for that and income. When you start trying to use these things for every single financial problem, that's when things really start to fall apart. Yep. And because you're trying to use it for something it wasn't designed to do in the first place. With whole life, for me, I'm not even really a big fan of taking loans for income from a whole life policy. Not saying you can't do it. Obviously, there's certain ways you can manage it. You got to manage it really good. The other advantage too is that whole life is guaranteed to grow every single year. It's probably going to continue to get the dividends. We don't really have to worry about those 0 years in an IUL. Like, if you have a $300,000, $400,000, $500,000 loan balance. I mean, we'll use this example, Dan. What if she? Because I imagine that the income was illustrated using a participating loan, because that's usually what agents show. What happened? It's not going to take long at $56,000 a year. Let's say she did that. It's not going to take long to rack up a pretty significant loan balance, $400,000. I mean, it was only going to take 5, 6, 7 years to do that. Well, what happens when you have a 0 year and your cash value does not grow by what was illustrated? Because IUL show growth every single year, as if we're in some eternal bull market. It's never going to happen. But if you have a loan balance of $400,000 with an interest cost of, let's say, 5%, you're not making premium payments. Your policy doesn't grow that year because the market didn't go up. Where does that interest cost come from? We're talking about tens of thousands of dollars in interest costs now.
Yep.
It gets taken from the cash value, guys. And you want to talk about, that's why, like, one of the most frustrating things about these policies is that sometimes it's too late for people to do anything. Fortunately, this lady, you found her, she found you, etc. Quite frankly, a $4,600 hit is pretty small, comparatively speaking, to some of the other policies I've seen that have been 1035 exchanged. So, a small lesson there. But what if she never came across your content or whatnot, and she's 70, 75 years old, doing what this agent told her to do, and all of a sudden her cash value is being crushed because the market doesn't go up every single year. You're 75 years old. Your cost of insurance is through the roof. The net amount at risk is blowing up. The policy is gone.
Yep.
You lose everything you put into it. You lose your coverage. You might even have a massive tax bill as well. Yep. And everything I just said, is that guaranteed to happen? No. I mean, this policy is currently outperforming. Maybe that wouldn't happen. But people need to know that it can. And I can almost guarantee you that agent did not disclose anything that we have discussed, any of those things, any of those scenarios that we've discussed so far. That's shocked. The biggest issue. Yeah.
Yep.
And I noticed one other thing that I wanted to bring up with, I wanted to get your take on the policy design, all right? Because I know that I can already see it in the comments coming in from IUL agents. Oh, it's not designed correctly. That's their go-to argument, okay? So do me a favor, real quick, Dan, scroll down to where she's not funding it anymore. And what I noticed is that the difference, so that second column there, that's the death benefit, right?
Yes, right here.
Okay.
Yep.
What I noticed is that her net amount at risk is pretty high, and that death benefit is continuing to grow. So it looks like maybe it wasn't illustrated with like leveling off the death benefit. So if it starts with an increasing, they eventually change it to a level. All right. So what that does, guys, is that is supposed to shrink your net amount at risk, because that's what your cost of insurance is actually applied to, whatever that net amount at risk number is. In this case, I don't see that. I see a really high net amount at risk. It looks like it's declining a little bit, but, like, for example, at age 70, I mean, she's got close to $400,000 net amount at risk. Like, she's being charged for $400,000 of death benefit there. That's a pretty significant cost. So it looks like the policy wasn't even designed correctly either, even though it's outperforming. What are your thoughts on the design of this policy? Do you think it was designed correctly, or is what I'm calling out is that looks like an issue to me?
It absolutely does, yeah. And it's the kind of thing. Again, having seen a whole bunch of these, that even 6 years in, you can tell it's complete garbage. It's not doing anywhere near what it was supposed to be. To see a policy that's outperforming, I would say initially during the accumulation phase, it seems like it was designed decently, but it certainly wasn't illustrated with changing to a level death benefit where that net amount at risk is going to decrease over time to control that cost. And that goes back to, these have to be managed well. You've got to have an agent that understands how to manage it,
right, as
well as design it right. And as the insured, you've got to be proactive enough and understand that, hey, we're going to have to come back and make some modifications here.
Right.
I don't see that happening here. And so, what the agent's intent was is hard to say. From our conversation, that was nowhere on her radar, that, hey, when I'm ready to scale back premiums, we've got to revisit this. We've got to see about adjusting the death benefit to control the cost. Right. That certainly wasn't on her radar. Whether or not it was on her agents, I don't know.
Right.
But from what's on paper, I totally agree.
Yeah, it really ever is. And in fact, I hear IUL agents constantly talk, like anytime I bring up cost of insurance, they just laugh. Oh, that's not an issue. That'll never be an
Yeah.
issue. So well, I suppose if the policy performs and you manage it and the stars align, maybe it's not, right? Because you can lower the death benefit. But here's the thing: a lot of I think there's some companies that will do it automatically, like you can put it in the policy to automatically level the death benefit. But I don't think no, the company would not automatically lower the death benefit. So let's say 20, 30 years goes by, is your agent still going to be in the business? Number one.
Mm-hmm.
Is the company going to actively reach out to you to go through an in-force illustration every single year? Probably not.
Nope.
And are you going to even know to reduce the death benefit when you start taking retirement income? Because if your net amount at risk is too high, like it is right here, your policy is going to blow up. I hate to use the word guarantee here, but I've just seen this so many times. And if you don't manage this thing like a hawk, you have, in my opinion, you have no business buying an IUL.
Yep.
Period. You have to manage this thing, guys. Otherwise, it just does not work.
Yep.
And so, yeah, go ahead, Dan.
Yeah. I was going to say, to kind of to your point, is the insurance company going to come in and do that for you? I mean, think of the liability that would create for the insurance carrier to be going in and proactively reducing people's death benefit without the request of the policy owner.
Right. Not going to happen.
That's not going to happen.
They might switch it to a level death benefit. Yeah, I think some companies you can tell them ahead of time to do that.
Yeah.
But as far as reducing the death benefit, I don't even think they're legally allowed to do that.
Yeah.
And so if you don't do that, you could get into big trouble.
Yep.
Right.
Yep.
The other thing I wanted to get your thoughts on, Dan, with regards to policy design real quick, because again, here's the thing is if you're going to do an IUL, work with the right agent who is going to design it correctly, because design is important. You have to design it and fund it properly. You can have the best designed, the most perfectly designed IUL in the world. If you don't fund it properly, it's probably not going to work. But here's the other issue I have with the policy design argument. Dan, tell me what you think about this. Is, again, you could have the most perfectly designed IUL in the world. The problem is when the insurance company starts changing everything in order to manage its risk. So what I have seen, you probably have too, Dan, is that many times the life insurance company the agent will run these illustrations when the cap rates, as one example of one thing that the life insurance company can change, cap rates are high. Might be 11%, 12%, 13%, right? And that's when they run the illustration, and then they show you like 6.42% on the non-guaranteed side, so it's conservative. Here's the question. What happens when the life insurance company lowers the cap rates, the participation rates, increases spread charges, all these things change? What does that do to the long-term performance of the IUL, regardless of how you design it? So and I've done videos on this, it's crazy how much lower the cap rates are, especially compared to, here's what they do, guys, is they'll lower your cap rates, they'll write that off as a marketing cost, and then they make new IULs at the original high cap rates of 12 to 13% and sell it to new policyholders, while you have been paying into it 3, 4, 5 years, and your cap rate's 8, 10%, 11%, whatever, and it's slowly going down over time. Yet new policyholders are falling for the same scam with the original 12, 13% cap rates. That's what they're doing right now, guys. It's just, I don't know how that's legal, but
it's unethical and immoral. It's unbelievable to me.
Give me your thoughts on the policy design argument, and when, like, even if you have a perfect IUL, and again, correct me if I'm wrong, it seems to me that it really doesn't matter, because when the life insurance company changes all these things, your policy is still going to suffer. What are your thoughts on that?
Right. Yeah. For me, one of the reasons, I never imagined I would sell anything ever. One of the reasons I love selling whole life insurance is not only because I know what it's going to do for people, because we're setting it up the way we do and we're teaching them how to use it, but even when I see somebody who brings me a policy that's all base, not great, nothing like what I would do, if it's with a good mutual company, I'll usually tell them to keep it, because even a poorly designed whole life policy is going to be great over time. It's going to do great things. With an IUL, there's just too much that has to go right and too many things out of your control that can blow it up. And And far too often you don't figure it out until it's too late in life to do anything about it. Going back to your comment a few minutes ago, this thing blows up, you lose all your contributions, you lose your coverage, and you're too old to get either one back.
Right.
And that to me is the crux of the issue. There was a point in my career where I was like, IULs are garbage, period. And I've seen enough content. I love the interview you did with Seth Wasserman, I don't know, 9-10 months ago, whatever. I mean, that was really good. Like,
thank you.
His content on LinkedIn and the conversation you guys had, he's convinced me it is possible to design an IUL well. Sure. It's possible to have it managed well and have it turn out well. But to me, life insurance is about counterbalancing the risk and the volatility that I'm taking in my investments, whether that's real estate or a 401k Absolutely. Or crypto or whatever. Life insurance should be something I can count on all the time, no matter what. End of story.
Right.
And I can do that with whole life. I can't do that with an IUL. I can't. There's just, even if it was designed right.
Right.
To your point, the insurance company can play too many games. There's just too many things that can go wrong and too many things that have to go right for it to work out. Mm-hmm. Why take the risk? Why take the risk that you happen to be working with one of the small percentage of IUL agents that actually knows what they're doing, can set it up right, can help you manage it right. You're going to be able to fund it right. The insurance carrier is not going to play games. Why take the risk?
Right.
That to me is the bottom line, is even if it's all done right, the insurance company has to be ethical. They have to play along, and all those other stars have to align. Whereas with a whole life policy with a mutual company that's been around for a long time, all I need them to do is keep being really good at underwriting death benefits. And as long as they can do that and be good at it, my policy is going to be fine. And it's going to be that foundation that I can rely on all day, every day for the rest of my life.
100%. There we go. All really, really good points. And to your point really quick about Seth, if there was any, here's the thing. I'm in the same boat as you, where he did convince me that an IUL can be done correctly. Like, if there's anybody that I would recommend to go to have an IUL set up, it would be Seth, 100%. Mm-hmm. But even still, just because I was convinced that it could work, I was still not convinced to buy an IUL, not even close. Yep. And he did it, like, when I saw the illustration that he brought onto the interview, I was like, to me, this is how IUL should be illustrated. Mm-hmm. Okay, like, he did it really well. He's got 0 years inserted in there because the market's not going to go up every single year. He's not a fan of the participating loans for creating income. He does withdrawals and then wash loans, right? So you're not having that the loan balance risk and whatnot. But even still, like you said, it's not worth the risk. Like, there's not enough additional reward over a whole life policy to do an IUL. Okay. Right. Now, if an IUL could realistically earn and like above and beyond, let's say 3, 4, 5% over a whole life policy, and there wasn't so much risk and so many things that we can't control, maybe it's a viable option. But if it's only going to, and Seth even talks about this, he talked about on the interview, like, if it's only going to do an additional maybe 1%, let's call it 2%. Above what a whole life policy would do over your lifetime, that is not enough additional reward for the risk that you are taking on, with all of the things that have to go right, but all of the things that can go wrong. That's not a good risk reward profile.
Right.
And to your comments as well about, like, the risk that you take in your investments, just Chris Kirkpatrick put it to me this way a long time ago. He said, "Would you ever take risk in your savings account?" Mm-hmm. Then why, if not, then why are you doing it with your life insurance? Because life insurance is a safe asset.
Yep.
That's why, like, when people compare it to the market, it's just really stupid, because you have your riskier investments that get higher rewards, but then you have your safe money, your safe capital, right? Why are we trying to take all of this additional risk for an extra 1%, maybe 2% of percentage points of growth over a whole life policy? It does not make sense. And where I earn my returns, where you do yours as well, Dan, we were talking earlier about, doing the real estate, that's where we earn the returns, right? But we don't have to worry about what our policy is doing, right? We know it's going to grow. We know it's going to get dividends, and we could borrow against it and then take risk, calculated, educated risk, obviously.
Right.
Right. So when I borrow from my policy at 6%, lend it out at 13% plus a point, that's where I'm earning my returns. I don't care if an IUL can get 6%. I don't give a crap. My policy over here is going to do 4, maybe 5% tax free over the life of the policy. I'm creating positive arbitrage over here with my investment strategy. Why are we getting greedy here with something that doesn't even have a good risk reward profile? Right.
Exactly. Yep.
It does not make sense even when it's done right. So we can go ahead and start to wrap up. I want to be respectful of your time, Dan, and maybe I can have you on again, and I'm sure we'll have many other conversations coming up on, like LinkedIn. Like there's always stuff on LinkedIn with IUL or whatnot. But just a couple of final things. I want to get your thought on, do you think, like, have you seen or worked with anybody where an IUL does make sense? And one of the reasons I wanted to ask you this is Andy Panko, who we both follow on LinkedIn. He's got really good content there. He actually made a comment the other day. I think it was after he did a podcast with somebody that sells IUL, and he said that I'm going to butcher it a little bit, but he said that the majority of the masses should not have an IUL. And I think what he was getting at is that because it's such a complicated product and it needs to be managed and designed really, really well, that for your average person, it's just not a really good financial product. Going back to at least how it's sold, right? So in your experience, do you see can you picture a scenario where an IUL would make sense for somebody, especially over a whole life policy?
It's interesting you asked that. I was actually thinking about that question yesterday. Honestly, I don't. I look at the IUL concept and it sounds great, right? You eke out a little more return on your savings and you don't have the market risk. The concept sounds great, but when I look at like most things that try to be multiple things, it doesn't do either one. It's like it's almost trying to be an investment, but it's not. To me, it's not a great permanent life insurance solution just because of the risks that we've talked about, that it goes away. To me, it's just life insurance. Again, it should be part of my my financial foundation. It should be something I can count on. And I don't feel like an IUL can be that. And so I don't really see a place for it. And that's not to say there isn't one. But I just have not been able to envision a scenario where it makes sense, because in my mind, I've got risk assets and I've got foundational assets, and I use foundational assets to stay safe, to sleep well at night, to know, no matter what happens in my risk assets, I've at least got this pool of money I can count on. And then I've got risk assets, and they do that really well. And there's volatility and there's uncertainty and there's that upside reward that I get for that risk. Right. To me, an IUL is trying to be both, and it doesn't do either one very well. And so I personally I haven't been able to think of a scenario where it makes sense.
Right. Yeah. You and me both. I haven't seen anything where it does make sense. When I think about it, maybe if you're just using it for, a death benefit, like a legacy play, maybe, there's different types of, obviously you're going to get a lot more death benefit than a whole life policy. If you do it like, Seth talked about in the interview, you can do it very conservatively, but then you have to ask yourself, is it worth the extra potential reward? If you say yes, then maybe it's a good fit for you. But beyond using it as a legacy play, I can't see it. I don't see the point of it. And here's the thing that I think a lot of people forget about too, is that universal life insurance in general just has a horrible track record. Yes. I think just based off what I've seen, it has significantly hurt far more people than it's helped. And IUL is just like the third version of UL, universal life. So it's built on the same broken chassis, annual renewable term. It's just a different interest crediting strategy. So if we look at the history of this product, not just the IUL, but universal life itself, all we've changed is the interest crediting strategy. Do we really think that it's going to be better than the other versions?
Right.
I don't think so. In fact, I think it's gotten even more complicated where, now you have options and futures contracts involved and all this crazy stuff,
Yep.
that adds additional cost. That's why I also like the illustrations for IUL are just so misleading because they base it off of the historical performance of, let's say, the S&P 500, but it has very little to do with the S&P 500, right. The IUL performance.
Yep.
Because it more comes down to the options budget, the options cost, cost of insurance and all this stuff, cap rates that are often lowered, whatnot. So it's like, how can you actually predict with any reasonable amount of accuracy what an IUL is going to do when it has really nothing to do with the stock market itself?
Right.
I mean, you're basically an options speculator.
Yep.
With an IUL, and if that's what you want to be, fine, go for it. If you know and understand how an IUL works and you want to do it, go for it. I don't care. But I think
in that scenario, just go be an options trader. You're going to make more money.
Do it yourself, right?
Like get the insurance cost out of it, and just go learn to do the strategy.
Right. Yeah. Otherwise, stay away from it because it's just not worth the risk, guys. So. With that said, I guess we'll go ahead and wrap up with that, Dan. Was there anything that we didn't cover that you wanted to cover on the illustration at all, or any final thoughts?
Yeah, I think we went through it all. At the end of the day, I'll stop sharing here if I don't mess this up. At the end of the day, to me, it really just comes down to these are real people's lives that are being impacted by this.
Yeah.
This gal and so many other people I've met with, they planned their future around these things. Right. And so when they I'm working with another lady right now that planned to be retired right now, was told she could do it with her IUL. Now she can't, and we're having to not start over, but significantly revamp her strategy. Like these are real people and real lives that are being upended by this and hurt by this. And it just, again, it's not that an IUL can never work. It's just so many times it doesn't that I can't get behind it.
Right. Like, do you want to bet your financial future on it?
Right.
You're going to be the one where it does work out. Not me, man.
Yep.
Not me.
Ultimately, I think the thing that irritates me is the same thing that bugged me when I was a new college grad going into 2007, watching the market peak, and my coworkers that were supposed to retire in 2008 lost half the value of their 401ks in 18 months as the market fell. And just seeing the rug get pulled out from people who had done everything right, they followed all the rules, they funded it correctly, they were in it for the long haul.
Right.
And the system, the problem was the system that they were in. They were just in a rotten system. And to me, that's unfortunately what an IUL is the majority of the time. It's just a fundamentally flawed system that can't reliably deliver what's promised. Right.
So I think financial education is so important. Like, you don't have to become an expert at these things, but you do need to understand where you're putting your money, guys, whether it's an IUL, whole life policy, whether it's a 401k, it doesn't really matter. If you're just doing things because that's what everybody else is doing, or some financial professional told you that's how it's done, and you're not doing any research, man, you're really rolling the dice. You got to take some controls. You got to take charge of your personal finances, and it starts with educating yourself. When you're more educated, you're less likely to fall victim to these types of things. You can make more intentional and strategic moves with your money that align with your values, your beliefs, your goals, as opposed to just put money in the market. Or, when you see an illustration, it looks really good, but we don't think to ask additional questions and kind of go down the rabbit hole a little bit more. Like, is this actually where I should be putting my money? And it can be very, very costly if you don't do that. I say sometimes, like, the biggest cost with that will incur is a lack of financial education, and a lot of it is you gave some great examples today of that. So, anyways, Dan, really appreciate the time, man. I would love to get you back on the channel at some point. Maybe we can do talk about some infinite banking stuff that we're doing. It's one of my favorite things to talk about. I think it's really powerful. If people learn it, and how to actually implement it, it can be a game changer. It's been a game changer in my life, so maybe we can do that next time. But I'll guys, if you want to connect with Dan, I'll leave some links down in the description, and make sure you connect with him. Dan, what's the best way to connect with you? I've got you on LinkedIn, but do you have a website or anything like that people can visit?
Yeah, either LinkedIn or wealthoutsidewallstreet.com.
Wealthoutsidewallstreet.com. Okay.
Yep.
So we'll put all that in the description. So make sure you guys connect with Dan. All right, brother. Well, I really appreciate your time, and look forward to the next one.
Hey, thanks for having me on.
Yes, sir.